Hi, Harry here on Friday, October 6th with the Rant. The stock market's been going sideways for the last few months because it doesn't want you to know what it's about to do. And I say the odds continue to be strong that we are about to enter the third wave down. In other words, the middle crash out of a longer crash with three waves down. The first wave down we saw in 2022, big bounce, into recently, okay, more than it should have done, okay. But that's, that just shows the markets are still on crack, okay. So they need to get the crack shaken out of them, and this next wave should be exactly what it does. So again, we had this bounce peak so far in mid-July, and it's been coming down. And now, it's got its first wave down of that wave and it's bouncing sideways. I think it's getting ready to crack and we should see it going down soon. Now, this larger third wave, which again, should have started in around July 19th, okay, should take us to the COVID lows. That means a bigger crash than we saw in 2022 with the big first wave down. That was down 38% on the NASDAQ. This should be down 50% plus to reach those COVID lows in all the major indices. So that is also consistent with the fact that this whole thing has been held back by the massive stimulus, the overreaction, I call it, to COVID, 5.2 trillion in 2 years of just monetary stimulus, not counting all the fiscal. That's bananas. That's the biggest single stimulus program in all of history. And the reason that the economy is slow to react to this massive 5.25 going on very likely now after the jobs report today on Friday to 5.5 percentage points up, okay? That's the biggest raise in rates since the late 70s, okay, in 40 years, okay? Well, COVID was the biggest stimulus. They overreacted there. So what I keep calling this yo-yo stimulus. So we have this fight between the lags. The 5.2 trillion stimulus, COVID stimulus, should be start to wear off right about now and just keep wearing off in the next year and a half plus, while this tightening, which started early last year, 2022, should just be starting to hit and be hitting at its maximum on a year and a half lag into mid to late 2024. So everything says things are going down in the next year and a half. The stock market is acting like what? A soft landing. Stock market loves to assume soft landings. Never, ever happen, and I don't see any way it's going to happen this time. If it does, it's the first, and you just can't bet on that. So, what are we seeing here short term? Looks just like 1987 to me. That's kind of a weird thing to say, but 87 was the time when Treasury bond rates went up strongly and stocks bubbled into 87 and kept going up while rates rose, long term as well as short term. Well, we've just seen the longer term, the 10-year Treasury bond in the last 6 months go from 3.3% to 4.9% recently approximately, before backing off just a little. Stocks haven't reacted to that. The stocks aren't supposed to do bad when, especially the long-term rates go up, okay? So this is likely to be hitting soon, okay? What we have here, very simply, is a showdown between the real economy, which is at its lowest phase of Generation X slowdown after the baby boom peak, the slowest right around here in 2022-23, getting ready to turn up with the millennials, while the artificial economy is still on crack from the COVID overreaction, 5.2 trillion. So again, I don't see any way this can go but down. And I think stocks, again, had that big two-wave bounce, didn't make new highs. That's a really good sign. Looked like they might. And is now heading back down. And I think it's going to break down more strongly just ahead. What you need to be looking for, folks, real simply, the NASDAQ crashes back through 13,000. It keeps going down. That's the sign this third wave's kicking in. And again, the only real support is the COVID lows. And if they go there, that's going to be enough, I think, That's going to have the NASDAQ down 60% or more. That's going to be enough for investors and economists and politicians to start saying, uh-oh, we're in trouble. It's going to take the rose-colored glasses off that we've had on since the massive stimulus from 2009 forward, okay? So, and the one sign that just, is said for a long time, this is not going to last. This is an artificial boom. It's when money velocity is falling while the economy's growing. And money velocity crashed from 1998 into recently 2021, crashed from 2.2 down to 1.1. Biggest crash in a long, long time, okay? And it just bounced a little now, and I think it's getting ready to turn back down, and it's going to go below 1 next time. So basically, when money velocity crashes like this in history, like in the early 30s, like in the last major downturn, it basically says we're going into more of a depression than a recession. So I think we still have a short, deep recession or depression coming into 2024, and we'll have to see. It may last longer than that since we put back. And again, my bottom line analysis, which I've been covering in the October, and I'll do more in the November issues of the newsletter, the biggest cycle convergence in my lifetime and most of your lifetimes, okay, comes into late 2022. And what all this stimulus has done is push that back, by my best measurements, about 2 years. The top came in late 2021 for stocks when it should have come, the final rally, into late 2019, early 2020. So we're about 2 years off. That means instead of the final long-term bottom in late 2022, again, strongest cycle convergence ever, it should hit around late 2024. So we'll see soon. But folks, this little rally here recently, we've started down that third wave. I think this rally is not going to last very long, and if NASDAQ breaks 13,000, you better be out if you're not already out, and I'd be clipping now if you haven't already sold your stocks and gotten conservative, okay? Anything could happen here in this unprecedented circumstance, but everything says to me, we're about to go down, and we may actually see the real economy, the one I know and love and know how to forecast, to take over from this artificial economy if this third wave can go down to COVID lows and basically bring reality to all investors and economists and analysts. And then it's going to be hard for whatever, the next big stimulus round to have a big reaction when people feel like, no, we've already blown it. We've already done one stimulus after the next, and all it does, and all it has done, is take us to new lows, and that's what should happen into late 2024 or later. So put on the seatbelts. We should see some action by year end. If the markets do not follow through, I'm going to have to be looking at, maybe we have a sideways scenario for an extended amount of time. I don't want to see that. I can tell you the economy wants to get rid of these bad debts, get rid of this financial asset bubble. All of this creates speculation, and that's why money velocity has been falling since 1998. And that says you have to have a washout. We're keeping the economy from going back to real productivity and positive money velocity. So I'll keep you updated. Look for something to happen soon.